Have you ever looked at a trading chart and seen those red and green bars? They're called candlesticks. They show everything about price movement in just one shape. Today, we'll break down what a candlestick is, how it works, and why it matters to every trader. A candlestick is a visual way to represent price movement during a specific time period. That time could be 1 minute, 15 minutes, 1 hour, or even a whole day. Each candlestick tells a story: where the price opened, how high or low it went, and where it closed. Every candlestick has 3 parts. First, the body showing the opening and closing price. Second, the wick or shadow showing the high and low during that time. Third, the color green means the price went up. Red means it went down. If a candle is green, the price closed higher than it opened. That's bullish. If it's red, the price closed lower. That's bearish. These candles give clues about who's winning, the buyers or the sellers. Let's talk time frames. On a 1-hour chart, each candle represents 1 hour of price action. On a daily chart, it shows a whole day. This helps traders plan for short or long-term trades. Why do candlesticks matter? Because traders use candlestick patterns to make smart decisions. Some patterns show reversals, like a doji or hammer. Others show continuation, like a marubozu or bullish engulfing. Reading candlesticks is like reading market psychology. Candlesticks are the foundation of technical analysis. Every chart, every strategy starts with a candle. Master candlesticks, and you'll understand price action deeply. If this helped you, like, subscribe, and leave a comment below. In the next video, we'll explore doji candlestick patterns every trader should know. See you there.